Today's sales strategy, dollars of benefits for pennies of cost. Hi everyone, I'm Steve Savant, host of the daily talk show, Let's Get Down to Business.
And I'm Don Prince, Senior Advisor to Ensmark.
Don, today we're talking about dollars of benefits for pennies of cost. When you talk about that, what do you mean?
Yeah, what we're going to show today is based on the premium cost of the cash value policy and the death benefit that you get, what's really your cost in pennies for each dollar that you can generate for death benefits for heirs or that you can generate in cash out of the policy. And so that's what we're going to look at today.
Well, we're using a male 40, and the illustration is going to use an increasing death benefit option. And in our case study, we're showing a graphic per cost of dollar for $500,000 using a universal life policy illustrated at 5% with level annual premiums of $7,200, illustrated keeping the policy in force at least to age 95. Okay, now let's just show this graph and walk this through because I think people who have never seen this before, this is a great pictorial educational piece.
Yeah, this is the old Ben Feldman concept. We owe him the gratitude of explaining this to the industry. And basically the idea is with that annual premium, this is the cumulative annual premium against the death benefit. And as you can see, when you first get the policy, you know, for $1 of death benefit, your premium, you've only paid one or two premiums. It might only be 1 penny or 2 pennies. But even out to age 100, as you can see, you're still only at about 35 cents for $1 of death benefit, even out to age 100. And obviously it grows over time as you're paying more and more premium. And so assuming a death at any of these years will tell you how many pennies it cost you to get $1 of death benefit.
And I love the leverage of this because it just shows even in the most extreme year, somewhere around life expectancy, we're talking what, 37.9 cents?
37.9 cents at age 100.
I think that's a huge, I like to talk to clients about leverage. And remember, a lot of our clients understand that a lot of people have margin accounts and so forth. We're talking about leverage here. Now, in this graph that we're talking about the cost for the same universal life insurance illustration, 5%. And I want to walk me through now this time, we're going to talk about a little bit different about this graph. What is this graph talking about?
What this graph is saying is if you took the premium that you're paying in the cash value policy and you put it in the bank and earn 5% interest, well, then that would mean your cost in pennies for each dollar of life insurance would be higher because of the use of money assumption. So what we're showing here is, again, starting when the policy is issued. Obviously, if you died in the first year or two, you'd have $1 for only 2 or 3 cents. And if you do use a use of money assumption of 5%, what's interesting about this is you only get to where $1 of death benefit costs you $1, or in this case at age 100, $1.05, only in the last couple of years, so age 99, age 100. The point is that you're generating $1 of death benefit for less than $1, sometimes a lot less, all the way out to age 98. You're better off from now until age 98, and then it's kind of a push at age 99 or 100. That's a pretty good deal.
I like it because now we're showing the use of money, and I think that's a fair comparison.
Agreed.
Now let's go ahead and look at this next chart. Now what is this chart? Because the first time I saw this, I went, am I making money or did it go negative?
Yeah, you look at this and say, wait a minute, there's an error in the program, right?
Right.
And there's really not an error in the program. This is how efficient cash value policies are in terms of pushing out money to policy owners. This policy is different. This policy actually has premiums paid in and then loans taken out. And because of the efficiency of paying out loans, this is showing the cost for $1 of death benefit, again in the early years, and it actually goes negative because you're taking out significantly more money from the policy than you've put in. And you actually get down to negative 300 cents for every $1 of death benefit because you've taken out more than you've put in, so your cost is actually negative.
Are these traditional loans that we're using here?
These are participating loans. So
for Index UL.
For Index UL.
All right. Now let's look at this next one because this is similar, except for now you're actually using the time value money again, right? Aren't you?
Yeah, this chart is amazing because what we're using now is the total premium paid in plus a 7.5% use of money assumption. So assuming that money, that the cost of the policy is the premium plus 7.5% use of funds, interest. Even with that, you still are only at a few cents for each $1 of death benefit, and it actually goes negative starting in about the 35th year Because again, even with the use of money assumption, the efficiency of taking out the loans from the policy drive the cost per dollar negative.
To me, this is a really fair display of using the time value of money and comparing this to an index policy that uses participating policy loans. Now, I want to kind of go down here and let's see here.
I think it was right above here.
It was right above
Yeah,
here.
this was interesting. We ran that. We assumed that the premium that went in the policy had a 7.5% cost of funds. So go ahead.
Yeah, well, I noticed that you ran this at 8%, you ran it at 9%, you ran it at 10, 11, 12%, and the final year of each one resulted in a negative cost for each dollar of life insurance. That was, to me, impressive because we actually kept bumping the actual rate of return higher and we were getting our cost. It was still negative.
Yeah. Even if you have a 12% use of money assumption on the premium paid, you were still at a negative cost per dollar of death benefit.
And by the way, just to kind of go out and look at the illustration itself,
Sure.
Here's a little quick view before we close. Look at this is the actual display, and I like this because you're saying, well, Steve, what is this showing me? It's showing me the basic premiums, the income, my net payments, my cumulative payments, and all of this is set in my tax bracket, my rate of return, my premiums, and my initial death benefit. So I can actually look at this within INSMARC and actually get a pretty good idea of what this is. And remember, if I want to, I can compare this to other investments. That's why I think it's huge.
Exactly what you said. In the INSMARC system, this is that module. And here you can see the cost per dollar of funding. And here you see it going to a negative 8 cents, negative 16, negative 24 cents. Again, because of the efficiency of the participating loans and the net loan proceeds coming out on a tax-free basis.
This demonstrates so powerfully the dollars for pennies idea, and this illustration here actually shows it every year all the way out. Today's sales idea is brought to you by Ash Brokerage, the practice enhancement company.
And by INSMARC, the most widely used software when it comes to strategies and presentations using cash value life insurance.